Hey, good morning and happy Saturday. I wanted to stream this weekend and see if we can analyze some companies that you think are interesting. I wanted to review the market and kind of plan out next week. Next week, we'll have a lot of earnings again. So it's going to be a pretty active week. And we've seen the market grind higher. It hasn't been jumping up higher. There's It's interesting to see that companies that did announce well, going back to Netflix, we had a stock market that didn't buy into Netflix's success. They kind of thought they was going to be better than they reported. Netflix did report good earnings. The stock dropped like 5%. And we fast forward to another good earnings, which is Google. And Google did kind of rally into the earnings. Their stock price kept going up as we approached their earnings, and then they announced they had very good earnings, and the stock went up only 1%. To me, that's a sign that, hey, the market recognizes stocks are high and it's being careful. I should say investors are being careful because the market is just a makeup of all the investors that are buying into stocks. So this coming week, we have big earnings from Microsoft, Apple, Meta, and Amazon. And if they all report good earnings, we can go higher. But I am beginning to feel that Apple may have a hard time reporting good earnings. And if they had a bad earnings report, it wouldn't be a giant surprise. I don't think people would be completely alarmed that, wow, this came out of nowhere. Apple's been struggling and their stock's down year to date 14.59. The heat map I'm showing is year to date numbers. Tesla's pretty much down. It should, if you look at the fundamentals, it should be down far more. It's just a really popular stock for a lot of investors that like the story behind Tesla, and I'll let them invest in Tesla. I will not invest in Tesla. I'm more of a fundamental investor. I like looking at the financial statements, making my decisions based on the information that is in financial statements. But as we move to, so Apple is going to announce next week. I'm expecting they're not going to break any records. I don't think they're going to show big growth. I think they're just going to explain why they're not growing one more time. And we'll see what the market does with that stock. Amazon, that's a wild card, very wild, because most of their revenues are e-commerce, and we've had trade disrupted by tariffs this year. I think there's been a lot of pull forward. How's that going to affect the second quarter for Amazon? We'll find out. We'll find out next week. And we'll see if Amazon's going to trade up or down. And I think Amazon's cloud business is going to do well, judging from how well Google's cloud business is doing. Google's cloud business is growing at 32% top line revenue, which is very, very good. And that probably, and if you noticed, when Google announced that, Microsoft stock was up because they have a big cloud business, and Amazon stock was up because they have a huge cloud business. Both those companies, I expect their cloud business is going to do well. And the other parts of their business is what remains to be seen, and we'll see if they do well. And then the final company, Meta. Meta is, I think Meta's got a clear shot at becoming one of the most powerful AI companies in the world because they have over 4 billion people logging into a Meta application each month. That's a big population of users. So they can offer up their AI applications in a very positive, smooth way. I mean, just when you're using Facebook, you're presented with AI. When you're using Instagram, presented with AI. When you're doing WhatsApp, ditto. So all those things are in play for Meta, as well as internal efficiency as they run this big platform. I'm sure AI is helping out. So all those things are possible. And the other use case that's going to help Meta is I've heard that AI could become kind of a companion, so to speak, and it's, a AI agent that you can ask a lot of questions of and get a lot of information from. Well, that's perfect for Facebook or Instagram. You're there and you just keep asking the questions. Hey, what's popular? What are the most popular songs? Tell me whenever this artist is in town, and just asking it a bunch of questions, it'll store it and it'll remind you as you use Instagram, Facebook, and so forth. I think Google can do the same thing as we use Google for YouTube, Gmail, and all those other things too. So we'll see how the world takes on AI and how we consume it. It'll be an interesting next couple of years for sure. Great. So what we're going to do this stream is I've got some topics that I wanted to cover, but one thing that I like to do is I like to talk about things that you guys want to talk about. If there's a topic, please put it in the chat. I'll try to talk about it. If you'd like me to review a ticker, a stock, if you're a member, a paid member of the channel, I review them just as a thank you for being a paid member. If you're not a paid member, $5 super chat, or you can become a member on the fly. It'll show up immediately, and then I can review a stock that you would like to nominate, and we can do a deep dive. If you're new to the channel, what's my approach to looking at stocks, doing research, and then making a decision to invest? Well, I like to look for businesses, preferably that are growing, that are in markets that I find to be desirable. These are desirable companies in desirable industries. They make a lot of sense. They have a good story for the next 5 years looking forward. I look at the fundamentals. I look at financials. The most important information that I see in a company is in the financials, represented by revenue growth, profit, free cash flow. I look at the balance sheet to make sure the company doesn't have too much debt. If it's a company that I believe has a very good story going forward, they're growing revenues, they're profitable, they generate a lot of cash, it's probably a very desirable business, and I'd like to be an investor. The next question is, when would be the right time to buy it? Well, preferably it's with a nice discount. Sometimes I have to be patient and wait for a stock to be discounted. But if I do my homework, I at least know what the intrinsic value is of a stock. And I can wait for pullbacks, corrections, and so forth, and then buy these really desirable businesses when the time is right. So that's how I go about stock analysis, research, and then decision making for my portfolio. So as we go through, if somebody puts up a ticker, we'll go through that process of looking at the business, seeing if it's desirable. What are the margins? Some businesses have incredible margins. For example, we looked at a pharmaceutical business yesterday, has 84% gross margins. Those are fantastic margins. We looked at a different business and had 29% gross margins. Well, those are two very different businesses. One, every time they sell $1 million, they get to keep, as a gross margin figure, they get to, after the product or service is delivered, they keep 84% of that $1 million, as opposed to the other company only keeps 29%. So the amount of profit and free cash flow that ends up going down to the bottom of the income statement for the company with 84% margins is just much higher. It's more desirable. It's more valuable. At the end of the day, we're buying companies that produce profit, cash flows. And what we want is a business to continue to grow at high rates. So the profit and free cash flow they produce in 5 years is much higher than what they produce today. That's the most desirable business. And usually businesses are growing at high rates and maintain that growth when they have great barriers of entry, moats. They keep their competitors away, keep them away with either patents, great ideas. They're just far better, and they have a real powerful network effect on the market or the industry that they're operating in. All those things come into play. So that's going to be the process we go through. All right, so I wanted to take a second before we jump into a couple of topics that I have, and I wanted to thank some new members that joined the channel. Andrew Cho, thank you so much. Joined yesterday. Mr. 123 Cheetah joined yesterday. I appreciate it. Matagonia, I appreciate you upgrading your membership. Mitch Yunker, thanks so much. Sandra Ocasio, thanks so much. And I would really like to get your connected over email, and then I can get you all these perks like access to my research, access to member calls. If you show up to a live stream, you can put tickers in the chat and I'll review them. But there's also access to the Discord. So I want to make sure you get, all the benefits that paid members get. So please get that over to me. My email address is victorhinvesting@gmail.com, and I put it in the chat for you. Just get that over to me, and I'll get all those benefits over to you. Thank you so much. And if you're not a member, consider being a member. I think it's really worthwhile. And I know that a lot of people come on the live streams and you add a lot of value. I appreciate that. And it'd be great to have you as a member of the Discord, of member calls. I think you'll get a lot of value first and foremost. Get a ton of value. Get a lot of good information from other points of view on a stock or investing as a whole. And it'd be great to have your input into the community as well. So take a look, see if there's a level that's good for you. It's pretty easy. You just go on the home page of my channel, look for the join button. It's toward the bottom on the right side, and you'll be presented with these 3 different levels and you get signed up. All right, so one thing I wanted to start with is the seasonality. And when we look at the returns that the S&P has had over the last 10 years, this is pretty good data. July tends to be a very positive month. We haven't had a pullback month, or I should say we haven't had a pullback in the month of July over the last 10 years. So chances are stock market's doing well. We just have 4 trading days. It's going to end up positive. So that's good. But as we go into August, you see some red, right? We've had some months, some pullbacks in the month of August. And like in 22 was a pretty ugly August-September combo. I went down over 13%. And looks like in 23 also it's an ugly period. August, September, October was kind of a pretty ugly period. Just saying that we have an expensive stock market, and we're approaching the time of the year where we tend to see sell-offs. We tend to see pullbacks. And we may see that as early as August. We may see it in September. We may see it in October, but it's not a bad idea to keep some cash around. Like right now, I'm really slowed down my buys. Got a nice cash pile. It's getting bigger because I'm earning dividends, earning interest, putting more money into my portfolio. And that cash pile keeps getting bigger. I'm trying not to be antsy about jumping into a stock, being very, very careful. And I want to see these earnings that are coming out next week. I think they're going to really dictate how the market's going to trade at the very end of next week and then the week that follows. So just be aware that, hey, we could be seeing a nice little pullback. Now, I'm not a pure contrarian, but when the market's doing so well, I'm up like 23.5% year to date. I'm doing great, making lots of money. Wonderful. So from a dollars and cents and looking at my portfolio, I should be really happy. And I am. But being the investor that I am, it's really fun, or it's gratifying to find a stock that's really discounted that I really believe in. And right now it's getting hard because stocks are really expensive. So a part of me is like, okay, we don't have a lot to like really sink our teeth into of stocks that are discounted. And when you have these pullbacks and sell-offs, then you have some stocks maybe that are sold off in a flurry, and then that the opportunity presents itself. So that's a little bit of like, you know, using the metaphor of Christmas. You know, Christmas comes when markets sell off. They come and they provide us offers to these companies where the companies are terrific and we can buy them at a discount. So we need a substantial, sell off like we had in um, March and April this year. I mean, that was a giant sell off. We sold off harshly in that period, and it presented really good opportunities to buy these stocks at a really nice price. So a part of me is kind of looking forward to the sell off, and at the same time, I'll need to stomach the fact that my portfolio will go down during those days because I own a lot of stocks. So that is what's on my mind when it comes to seasonality. I don't think anybody would argue that we are in an expensive market and the market has been going up. The market year to date is up 8.62, and that's after having a 19% correction to the S&P. So we took some good medicine back then, but the market just picked itself up and just screamed up. And that's the part that's a little uncomfortable. It's like, man, we went up 28% fast. If we had done that over the course of 18 months, it'd feel a little more like the market's kind of taking its time and just going up, but it's gone up fast. So good for us. That means we are wealthier, our stocks are worth more, and that's that. So we talked about seasonality. That is out there. And I see that Kevin's on from Lakeland, Florida. Thanks for joining. You guys, let me know if there's a topic out there that you think we ought to talk about. Put it out there. If there's a ticker you want me to review, put it out there as well. I wanted to go over the AI investing opportunity that's out there and kind of just review what is going to be a short-term AI winner. Obviously, our friends over at NVIDIA are doing tremendous. When we have, how you doing, Jeff? Thanks for jumping in. Vicious, how you doing, man? I could talk about Open a little bit, and I'm not sure about FICO. I've never looked at that one, but I'll come back to those. Thanks for bringing them up. All right, so near term, there's the companies I'm thinking in the short term for the AI trade, right? Obviously, NVIDIA is a big winner because they're selling their GPUs into the data centers that are building out AI. And these guys have been doing great. Year to date, up 29%, over the 1 year, up 51%. Everything's positive on this stock. And it likely will continue to run up. So short term, NVIDIA is a real big winner. I think that Broadcom is fortunate to be in the data center. They're doing really good, really well. And near term, I think they're going to continue to run up. So that's going to be a winner. Now, thinking outside of semiconductors, GEV really announced great earnings. These guys do turbines that produce power, and these data centers consume a lot of electricity. So these guys have been selling turbines into data center builds. So what these guys announced on the 23rd, 2 days ago, and they had good earnings. The stock has run up nicely and has been a super winner. Pretty much doubled your money in the course of 1 year, year to date, excuse me. So over the 1 year, it's probably doing better. So these guys, short term, as we have all these data centers built, these guys are doing really well. So GE is out there. And I've been able to jump into a stock that I think is doing really well, and that's ALAB, which is also a semiconductor, and they're doing really well as the data center gets built out. And just taking the energy, A couple of years back, I bought into Broadcom as I saw that the AI build out happening. I made some money there. I didn't buy GE. I didn't buy NVIDIA. I thought that the build out was not going to last as long as it has, and it certainly has lasted. And our friends over at Google, they announced and they said, "Hey, we're going to spend another $85 billion in building out AI infrastructure, and it's not all going to go to NVIDIA." Google actually designs their own chips for the data center, so they are going to spend it in the data center for two reasons. One is they want their AI business to be great. And two is they have a cloud services business. So companies, in fact, ServiceNow is one of their big customers. They just signed a contract for $1.3 billion in cloud services that Google is going to provide for them. I think over 5 years. That's a huge deal. So that's the kind of thing they have to do. So that's why they have to invest what they're investing in the data center. Not sure why this site is not updating quickly. There we go. And A-Labs is one of the plays that I have for the data center. And you see that it really sold off as we had the March, April situation. So it gave us a good opportunity to buy into this stock because really over the last couple of months, this has just been an excellent pickup that I had. This is part of the AI build out. And we got to be attentive to these stocks. When the market presents us, a really good opportunity, you got to jump on it because this stock's up 130% since April. So I was able to jump into this one, and it's really taken off. And the reasons for it: Astera Labs is growing at 200% because their semiconductors are really important for data centers. So short term, the data center, investment for AI. Big winners: NVIDIA, Broadcom, Astera Labs, GEV, and others as well. So that's a good place to look for short-term opportunity. More longer term, I think the players that are really going to sustain the revenues, right, are going to be Google, who has a huge, cloud business, Microsoft, Amazon, and Meta. Because these guys, when you look at their cloud businesses, Google is growing at, in the last quarter, they grew closer to 14%. And when you look at their data center, it's growing at 32%. And it's a big, big number that they have there. And I think that's going to be out there when they sell these cloud services. That customer isn't going anywhere. Like that ServiceNow contract I talked about, it's going to be for 5 years. So Google gets to make that money for 5 years. It's a very sticky business, and they get these customers and make good money, good profit. So these AI workloads that are going to the big cloud providers, they're going to be a sustainable revenue. I really like that, which is why I've invested in Google, Amazon, and Meta. Meta is a different story, which is Meta is building out their own AI applications. They don't sell infrastructure services, and they are going to build out a business. And I think that's going to be a long-term winner. So the AI investment trade has been the biggest trade we've seen, in the last 25 years since the internet build out, it seems. And boy, it's had legs, and boy, it's created a lot of value for these businesses. And I think it's going to continue. The choice I have to make is, do I want to play the long game, play the short game, or combination of two? I'm mostly playing the long game. The reason for it is the short game could end in 6 months, could end in 2 years. I don't know when it's going to end, but I'm fairly sure that the long game is going to work. I'm a little bit more sure that the long game AI is going to create revenues for Google, Microsoft, AWS, Amazon for the next 10 to 15 years, and they're going to benefit big. So that's where I want to be. I want to be successful for the next 10 years. So that's how I'm playing the AI trade, and those are the places that I'm invested in. So Not sure what you're doing with AI, but that's what I'm doing. David Knight, good afternoon from the UK. So you bought the dip on AMD? Good. AMD has done really well. And AMD is in that data center. And what I've heard is their technology keeps getting better and comparable to NVIDIA. That's a good thing. That's a real good thing. And AMD did sell off quite drastically and gave investors a real good opportunity to buy at $78 a share. Now it's 166. So AMD has been a winner. Absolutely. It's been a really good winner. So congratulations, David. And if you guys would like me to do a deep dive, let me know, but it takes a $5 super chat on any of these. I'm just going to talk about them high level. And if you're a member, I would do it anyway. I would do it automatically. But let's get to Jeff's Opendoor comment. So Open's one of these meme stocks, and these guys, what they do is their play on real estate is they'll buy properties for cash and then sell them, and that's what they do. Now, this has been tried. This was tried by Zillow, and they frankly failed. They couldn't make money, and it's a balance sheet intensive business because you're buying these huge assets, homes, and man, if the market turns, you're bankrupt. You're done because if you start selling these properties at a loss, you're done. You're paying a lot of interest and all this debt you have to carry because you have these properties on your balance sheet. Now the market over the 5-year, they didn't think this was worth much and sold off. At a point, Opendoor is worth more than $30 a share. So at one point, investors were like, well, maybe, and they were excited about it. But now the stock, really over the last month, it was trading way down here at 53 cents a share. And then a very legitimate investor that has picked up some stocks and done well with them, specifically Carvana, he said, hey, Opendoor could be worth a lot more. And he caused a big buying spree on Opendoor. It also created a short squeeze. So that's why we saw the stock go from 53 cents a share to now $2.54. But it's still this really questionable business. It doesn't make a lot of money, loses money. So this one here, this is not my game. This is what I put in I label this a casino stock. Warren Buffett, he phrased this, which I kind of like what he said is, the stock market could either be the casino of stocks or it could be the cathedral of stocks. And what he meant was, some investors would want to really gamble like on an Opendoor. Hey, I'll buy it, hold it for a month, make 50%, get out. Okay, well, that's kind of a gamble because if you look at the fundamentals behind Opendoor, I would stay away from this company. These guys are, unfortunately, they picked to operate a business that's going to be super risky and really have a high chance of going bankrupt. Now, the cathedral stocks is you analyze companies, you understand them, you believe in them, they have great fundamentals, they're growing, they have all the right fundamentals where you're a big believer in that company for the next 5 years, for the long term. Those are stocks that belong in the cathedral of stocks. Those are stocks that I really believe in and so forth. Opendoor is absolutely a casino stock. These are like roulette wheel. You put everything on black and you're either going to win or you're going to lose. And good luck if you're an investor of Opendoor. The other one was FICO. So FICO, Fair Isaac. I don't know a whole lot about this company. They're down 23%. Analysts think they're discounted. Now these guys are doing credit research, credit ratings for people. So they're providing that level of value. Now, I would think that AI is probably gonna disrupt these guys. It's AI could probably do this quite well. And if they don't have a strong AI strategy, they're probably just going to get run over by either big platforms that have AI that's going to replace these guys, or they're just going to go extinct. It's not needed anymore. AI does it. And maybe another business comes out with credit rating services that are AI powered. So these guys have been getting hammered for the year to date. Over the 1 year, you're just barely even. That'd be the big scare I'd have with this business. And they are growing, which is interesting. It is interesting that they're growing. And these guys are generating free cash flow. Looks good. They are priced a little bit high. If they're at 700 million in free cash flow, but they're trading at 37 billion. So knowing that I have some concerns around the business, I wouldn't put a big multiple on that cash flow because I'm concerned. So maybe I can get to 15 billion in market cap value, but not 37. This one's way up there, and there's too many concerns. So, what do you think about it? I think Vicious asked about FICO. Jeff, what do you think about Open Door? How would you play it? And be curious to see what you think. All right, so we talked about the AI trade. Let me comment on mergers and acquisitions. So the previous president and his administration had, and I'm going to kind of throw him under the bus a little bit, not a lot, but a little bit. They fought companies that were merging really harshly. And the example I put out there is Kroger wanted to acquire Albertsons, and the administration fought Kroger really, really harshly. That was really dumb because Kroger clearly showed that the market has new entrants into the food, grocery business in the form of Amazon, Walmart, and Target. And of course, you have places like Costco. And what Kroger was communicating to the market was we got to get bigger because we need to compete against these huge companies, Walmart and Amazon. They're in the grocery business. And the administration before the current one was not wise enough to observe that and say, yeah, you're right. So they kept Albertsons and Kroger from merging. Now, I would not be surprised if Albertsons or Kroger went bankrupt because it's going to be tough to compete against Walmart and Amazon. I mean, those organizations are huge and they get a lot of foot traffic for a variety of reasons, right? The new administration, they're letting mergers happen. We just saw the Paramount merger with Sundance or Skydance, excuse me, not Sundance, Skydance. And we've seen other mergers. And I think it's going to open the door to more mergers and acquisitions. That's real positive for small caps. So as we see some of these really interesting small caps operate, we've seen Google acquired a cybersecurity company. We've seen a lot of announcements, begin to come out. So I think the merger and acquisition activity is really going to pick up, and that's going to help the Russell. And specifically, it's almost like you buy lottery tickets and you buy these small businesses, because if you own like a small cap and it gets acquired, you'll be paid like a 50-60% premium overnight. I've been there and I've been paid that premium, and it's pretty darn cool when it happens. So I think that's going to happen more often. We're going to see small caps be acquired by the bigger companies that need to grow. They need new ideas. They want to go take over Some of these smaller businesses have brilliant ideas, and they want to give them all the capital to make sure those ideas work. They can take a majority of the market share for that new business. So I think that's going to happen going forward. I'm expecting it, and I'm beginning to see it. And the other thing that's going to help is rates, I think, are going to go lower. There's two expectations around that. First, the um, the need to keep rates higher keeps going down. I think that inflation is kind of stabilizing. It's a little bit high, but not a big giant problem. And the certain things are beginning to fall, like real estate is really slow, and I think property values in some areas are falling. That's going to help with inflation. So I think that long term, we're going to see lower interest rates. As interest rates fall on the 10-year, that's going to help mergers and acquisitions. And it's simple because the capital that the company that's acquiring, maybe they have to bring on some debt, they'll bring it on at a lower interest rate. Also, small caps are going to benefit. Whenever you have low interest rates, small caps flourish, especially like biotechs and high growth companies that grow very quickly in a low interest environment. So I think that's looking good, and I continue to kind of look for small caps that look really promising. What's promising? Well, high revenue growth, high gross margins. If they naturally have a product or service where they have high gross margins, that's an interesting company. They don't have to be profitable today. They don't have to generate cash flow. But if they have a path of growth and eventual profitability and free cash flow, that's excellent. I got into Uber a little bit early under those conditions, and it really worked out. And I've gotten into other businesses under those conditions, and most of them have worked out nicely. So that's what I'm looking for in small caps. I'm looking for high revenue growth with good gross margins. That's kind of like the entry price to being a stock I would consider. Then they have to have a good balance sheet. You can't have small caps with bad balance sheets, because you could have a great idea, too much debt, you go bankrupt, and the great ideas are bought as an asset when you go bankrupt. So great balance sheet, good balance sheet, high growth, high gross margin, I'm interested. And so small caps may be a great place to pick a couple of stocks that are going to be superb winners. And we'll see how that plays out. All right, so a stock that I want to take a look at, and it's because GE Vernova is doing great. There's two companies on Earth that create power generating turbines, and we just saw one. Let's talk about the other, which is Siemens. So here's Siemens Energy. So let me pick the right one. So this one. So this is Siemens. This is the German conglomerate, big company like General Electric. General Electric and Siemens have been kind of competitors and foes for the longest time. Very similar. And look at these guys. 1 year up 315%. Wow, incredible. Up 119%. So this is a really, really fantastic appreciating stock. PE is really high. Let's take a look at their growth. So this is what is head scratcher for me is you saw the appreciation of the stock. 17% growth to me is not incredible. It's like 100% is incredible. And for this company to grow, although in the past they haven't grown all that well because these are power generating units, it's not like they're being bought left and right. But now they're growing faster. I get that. Totally understand. But for the stock to go up at the levels it's been going up, that's what makes me think at some point this is going to really torture investors by going down in price, because 17% is not that incredible. And when we look at their margins, 15% margins. That's terrible. So you have low margins, 17% growth. Okay, that's okay. Like the growth is okay, but the margins are terrible, which is why I just have had no appetite for these businesses. The free cash flow, 4 billion in the most recent year. But before that, you see, they didn't naturally provide a lot of cash flow because of those low margins. This is a big business. This is upwards of $37 billion in revenue, and they're just cranking out 4 billion in their best year, $4 billion of free cash flow. In previous years, they were just barely getting to $1 billion of free cash flow, showing that those low margins they don't produce a lot of profit and cash flow. Having said that, I mean, this business maybe is worth 40 to 60 billion, and it's priced up at 89 billion because the story's there. Data centers need power. The power is going to need these turbines that generate electricity, and investors have really bought this up. But I'm going to stay in my lane. In order for me to invest, I need to see margins. I need to see cash flow. I'm good investing in that data center, but I need to see quality fundamentals. Look at our folks, these guys here, GE Vernova, year to date, doubled over the 1 year, up 300%. When you look at the growth, 8% growth. That is not incredible. That's like, whatever, 8%. Why just stock up 300%? And we look at margins, 18.47. Let me remind you of, you can be in the data center, but maybe we could, I like picking incredible companies, like 200% growth out of A-Lab. They're in the data center, and they have 75% gross margins, and they're a new business. Over time, they're going to get bigger, and those margins are probably going to expand to 80%. That's the business I'd rather invest in the data center, is high margins, high growth. And I think I'm going to do better with Astera Labs. This story, I get it. I get it. Business community's like, hey, these guys are going to be in high demand. I don't argue. But high demand is 8%. That's not incredible. This is incredible, 200%, or what NVIDIA is doing, which is incredible. Okay, that is incredible. So I just wanted to point that out. It's Siemens and GEV, not my investment, somebody else's. Not to say that it's a bad investment. Heck, they're up 300%. So it's just, I got to stay in my lane. My lane is doing great, making lots of money year after year. And it's because I take a disciplined approach and look for businesses that fit that criteria and qualify into my process. Q-Tung Nguyen, how you doing, man? Rambus, I'm not familiar with, if Rambus is, I think, a semiconductor company, right? So I think they announced, why is that name fresh on my mind? Yeah, they announced. And it wasn't pretty. So hold on a second. No, they're going to announce. Sorry, they're going to announce on Monday, I guess. And these guys have been trading down year to date. It's up. They're a semiconductor play. Yeah, 6.75 billion, growing nicely. And we looked at this on a live stream earlier. Look at these margins, beautiful, 82% margins. That looks pretty good. Free cash flow at 233. 233 cash flows. Yeah, this one might work. Somebody puts up a $5 super chat, we'll go deep on Rambus. We'll do full deep dive. So if you want to do it, Mr. Nguyen, or somebody else wants to go $5 super chat, we will drill into Rambus. We will go all the way. Give you an example of what I do. We'll look at A-Lab. We'll end up looking at a full valuation, looking at a cash forecast. This is Asure Labs. Looking at what the stock is worth based on cash flows, and we'll look at earnings per share. Look at the business all the way and see, are they currently priced at a discount or at a premium? So think about it. It'd be great to look at it, and we'll move on to the next stock. All right, so one stock that is a boring stock, so just putting the disclaimer out there. This is a boring stock, is Verizon Communications. These guys have been priced so low, like 10 PE, and they did have a good earnings. They've had, since their earnings, the stock has risen 5.48%. They pay a nice dividend of 6%. It's a pretty good looking dividend. Analysts think it's discounted. Now, this is a safe stock. This is like, people will continue to use Verizon Communications for internet access and their mobile phones. They just don't grow a whole lot. Okay, so this is in the boring category. You see their revenue, they've been at 130 for a while, for 4 years. Will they eventually get to 140? Yeah, eventually. But they're just growing really slow. They are a cash generating machine, generating $20 billion in free cash flow, and they pay that dividend. That looks good. Gross margins are good at 60%. So this one here is actually a stock that I would consider as discounted, because that free cash flow at 20 billion is going to create a valuation of 200 billion. But before I move to that step, now I remember why I dislike these businesses is the debt level. So when you look at a company, you got to make sure you look at the debt level. In this case here, these guys have $174 billion of debt. That's a lot of debt. And if interest rates go down, it is going to help them. But I just look at this debt level and I'm like, yeah, no thanks. That is why these guys are down 24% over the 5-year. These are businesses that require a lot of capital so they can install all the fiber optic lines to create, the access points to the internet. They got to put up cell towers, a lot of expensive equipment that they take out debt in order to have that equipment in the field. And that's just a business that, there's some attractive figures. For example, the dividend, the cash flow. But once you look at that balance sheet, it scares me away. So no, thank you. No, thank you, Verizon. All right, next thing on the list. So if you guys think of a topic, pop it in the chat. If you think of stock, pop it in there. I'll give you some comments on it. If you want me to do a deep dive on the stock, $5 super chat. If you're a paid member, I'll do that. No additional fee. Just pop it in there and we'll take a look. All right, so I wanted to talk about stocks in India. And India's been doing well. I'm invested in China. I'm good there. I'm going to continue to invest in China. I'm looking for one more stock, but I'm going to take my time. Stocks are kind of expensive. I'm just going to do a quick so the top market cap companies in India. Let's take a look. Hopefully there's a site that I am familiar with. Looks like we're going to end up with this one here. All right. So India is a growth country. Its GDP is growing. They have for certain industries, they're pretty strong. So I wanted to begin to research and see, which companies potentially are going to be good investments. And if anybody's invested in India, I'd love to see your comments in the chat. Which stocks do you think are good in India? That'd be great to see in the chat. Please put it in there. So this one here looks like Reliance Industries is their biggest market cap stock. And then HDFC Bank. Tata I'm familiar with. They do a lot of technology services. They also do, they're diversifying, so they have other things. I think Tata is the company that bought Jaguar, and they own Jaguar, the car company. And then this company I'm unfamiliar with. This might be a communications company. Bank of India. Infosys is also like Tata. They do technology services. Bajaj Finance. Unilever. Okay, this is the part of Unilever that's operating in India. Life insurance, ITC. HCL, I am familiar with, a lot like Tata and Infosys. Okay. Sun Pharmaceutical. Okay, interesting. So there's some companies out there, and I am familiar with Tata and Infosys. Let's take a peek at those and see if some of those look interesting. So it's TCS. Infosys is INFY. And then HCL. .ns. Okay. So it looks like there is one that's listed, and that's in Infosys. So Infosys, taking a quick peek. Year to date, it's down 21%. Over the 1 year, it's down 21%. It hasn't been a superb winner, 40%. Market cap 72 billion. We are dealing with US dollars. Revenues 19.5 billion. So you're paying 3.5 times revenue for the company. PE is 22.67. Now let's take a look at their growth rates. So not a high grower. They're growing a little bit, 4.5. That isn't all that impressive. It's okay, but not impressive. That's why the stock hasn't been on a big rise. They do cash flow, 3.878 billion dollars of cash flow. Margins are low because they're a services-based business. The services that are being provided, they hire people and then they provide them. So not really high gross margins. Yeah, so this one here maybe is worth, let's take a look at the balance sheet. See if they have a lot of debt. So the balance sheet, so cash, they have more cash than debt, $3 billion. That's very good. This business is worth 40 to 60 billion dollars if I do it in my head. Yeah, it's not a really good buy. And considering that I'd have to, like, I'm in the US, so whenever I invest in another country, especially India, where I'm not that informed, I need to get a high rate of return. So I actually be pricing this stock at like 20 to 30 billion dollars in market cap if I used a higher discount rate. So this one here is not for me, not for me. Let's take a look at these others like TCS dot. So here's Tata Technologies, and this is in the currency. This is the Indian currency. So IST to US dollar. So I don't understand that. Let me confirm that I'm looking at the right thing here. Okay, so market cap. Oh, I looked at the wrong currency. Okay, so here we go. That makes more sense. So a rupee is worth 1 cent, 1.2 cents of a US dollar. Okay. So going back to this valuation, so this is market cap's going to be 0.1, 1.2. So this is actually going to be about a $4 billion, $5 billion market cap business. Okay. P ratio is kind of high. Are they growing? Not really. Man, these growth rates are terrible. So I looked at Indian stocks maybe 6 months ago. I was kind of running into the same conclusion, which is, man, these fundamentals don't look good. Like when I look at China stocks, the growth rates are really good, profits are good, and I've invested in a few Chinese stocks. That's going well. But here I'm kind of running into poor fundamentals, no growth. So I'm going to pass. It's good to take a look once in a while, make sure that we like or dislike something. All right, so one of our members, he wanted me to look at DSP, and that's Viant Technology. Let's see where they're at. So year to date, boy, they really sold off. And over the 1 month, they're up about 8%. That looks good. This is less than $1 billion market cap. And these guys they help advertisers place their ads online, like on Facebook and YouTube, and Netflix, and Amazon Prime, Disney Channel, where you advertise online now. They help businesses with that. They have a platform that does it. They're less than $1 billion in revenue. When are they going to announce? August 11th. Okay, so we got a couple weeks before that happens. And they're growing at 30%, which is good. It's not incredible because they're tiny, right? $300 million business. Now, their margins, if I remember, not the greatest, 45%. That means they're hiring a lot of people to do this instead of using technology that would be really efficient and highly profitable. They have good free cash flow. And I think if you look at the value of this business, it looks good, but it's not. I think those margins are what make me pump the brakes on the stock. The PE is really high. And the best valuation I've got on DSP is that they're 20% discounted. And that just doesn't float my boat because it's a small cap. This could be an acquisition, but the big player in this space is AppLovin. And AppLovin has been working well. AppLovin has better margins, good growth. What's AppLovin been up to? Over the last month, it's up 4%. Year to date's up 12%. Okay. This is a big cap now, 123 billion, $5 billion in revenue. So you are paying up like 25 times, 24 times revenue. PE is really high. And the reason that PE is high is really good growth rate, 40% on a $5 billion number. These guys do the same thing that Viant does. But these guys are more a technology solution. When you look at their gross margins, really high gross margins. These gross margins look good. And when you look at this business at their high growth rate, you can value this business up to 100 billion. Right now they're at 123 billion, so they're too expensive right now. But this is probably the most exciting business in that industry. They have a little bit of debt, not too much, $3 billion, but that's not a big worry. Debt to EBITDA is 1.3, meaning they can pay off debt in a year, 1.3 years is what that means. So this one here is doing well. RSI is 54, so it's not overbought or not oversold. AppLovin, It's done well over the 5-year, but the money that investors have paid for it have pretty much priced the stock a little too high, and it's priced past its intrinsic value based on my calculations. So it's a pass for me. This space is just a little too expensive, not attractive enough for me to buy. So that is DSP. It's 20% discount, not a crazy good discount, and I'm good staying away. The other stock that was requested was Upwork, and Upwork needs to start growing. I like their business. I think it makes sense, which is they have a platform where people that are looking for gigs, right? Independent professionals or people that do things in the digital world can provide these services to businesses. And it could be a short-term assignment, a couple of weeks, it could be 6 months and so forth. Totally makes sense. Now, these guys, their stock is down over the 1 year. It's up 14%. You can see that it really caught a rally and then it sold off. Now, the piece that I like their business, but either their execution or maybe I'm misreading the attractiveness of their business to industries. It's only growing at 7%, which is terrible. And looking at the quarterly, see if this thing's going to update for me. It's not even growing at all, which is the biggest concern I have. These guys are small and they're not growing. So I'm not buying any Upwork until these guys begin to grow, maybe 20%, 25%. Then it'd be exciting. Or I'm just going to stay away because at their growth rate, they're just not going to be relevant. They're not going to take over and make a big marketplace out of this. Or maybe somebody else is going to take it and run with it and do better. But there's just not enough excitement in that growth rate for me to be an investor. So Upwork is a pass for me. Wouldn't be buying shares. Excellent. So, man, I am getting through things this morning, guys. I covered all the topics I wanted to cover. Is there anything else you guys wanted to cover? We've been going for about an hour. Just a quick reminder, I wanted to thank the people who have signed up recently. Andrew Cho, thanks so much. Signed up less than 24 hours ago. Mr. 123 Cheetah signed up a day ago. Matagonia, thanks for upgrading your membership. Appreciate it. Mitch, thanks so much for getting signed up. And thanks for emailing me. And Sander, please email me. I haven't received emails from a couple of these folks. And please email me. My email is victorhinvesting@gmail.com. I want to make sure that you get all the benefits that a paid member gets. Access to my research, the access to Discord, access to the member calls. Of course, if you go on live streams and you request a ticker to be analyzed, I'll do that. So please get me your email. Love to get that out to you and get you all signed up. If you are not a member, go on my homepage to take a look, see if maybe one of these memberships is good for you. You get greater access to my research, all my valuations you get access to, and you get access to the Discord, the member calls. I'll analyze stocks that you want me to look at. Looks like we have a super chat. We jump on that and take a look. So, all right, so let's get to this super chat here. All right, so looks like Sargil. Thoughts on ELV? Let's take a look. So Elevance and ELV, right? United Healthcare. So I think Elevance announced, and then United Healthcare is going to announce next week. So let's go through it. And thank you very much for the super chat. Cool thumbnail, by the way. Do you ride motorcycles? So ELV, Elevance just got sold off big time. I thought their earnings were decent, 17th, right? When we look at their earnings, let's take a look. They grew at 14%. Well, that's good. They're a big company. We're talking about a business that does $189 billion, okay, $1 billion of revenue. And they're growing in the quarter by 14%. That was good, okay? Now, where they created concerns on the stock was their guidance. They're not sure. And this big bill that came out is going to take away a lot of budget away from the low income programs that exist for people to get health insurance. That's going to affect Elevance and United Healthcare. But I think Elevance and United Healthcare have primarily corporate customers, meaning people that do have enough money to buy healthcare. That person is not affected. So I think it's overplayed, the whole scare around the big bill. These guys are producing cash flow, plenty of it, and profits are, and this is normal for health insurance payers. They're kind of a volume-based business. They're just so big, they create a lot of cash, $5.3 billion worth of cash. So this one here, now here's how I'm invested in healthcare and my expectations. Right now, it's going to be patience. Healthcare is severely discounted. I'll show you the valuation of both Elevance and United Healthcare. These stocks are severely discounted. When we look at the 1 year, this one's down 50%. And when we look at the 1 year, this one's down 43%. Similar to Elevance, when you look at the fundamentals, this business, and these guys are larger than Elevance. Elevance is 180 something billion in revenue. These guys are 410 billion in revenue. They're growing at 8%. So in a year, they add more than $32 billion of new revenue on the top line that they can make profit on, free cash flows, and so forth. And they generate cash. These guys generate $25 billion of cash. That's a screaming out loud number to me. And you're buying it for basically 10 times free cash. That's such a deal on United Healthcare. United Healthcare's primary market is corporate customers, big companies that have 100,000 employees, and they provide United Healthcare to their employees as the health insurance option. It's a very popular option for people. I've been a customer of United Healthcare for 25 years. Happy to be a customer with them. And now let's take a look at the valuations that I have for Elevance and United Healthcare. I think that Elevance, and remember that, I don't know if I've made this statement on this live stream, but I'm going to now, is in the near term, the stock market is a voting machine. The most popular stocks get all the votes and get short-term buying activity. And the meme stocks represent that quite well, which is, oh, hey, look, Krispy Kreme donuts. It's a terrible business, but the stock's really moving. Short-term, people are putting money in there. Over the long term, the stock market is a weighing machine. It weighs profits. It weighs, yeah, I like broccoli beauty contest. Very good. Short term, beauty contest. Hey, that company looks pretty. It's a voting contest. Long term, you have a weight of profits, free cash flow. Because Elevance is going to keep getting bigger, bigger, bigger. They're showing you 14% growth. They're showing they're driving free cash flow. And 5 years from now, they're going to have 25, 30 billion, $40 billion of more cash on the balance sheet. They're going to buy back shares. Instead of being 185 billion in revenue, you're going to wake up 5 years from now, they're going to be a $300 billion revenue company. All those things are value that will be weighed by investors long term. And these will be successful investments in the long term. Because Elevance, when I weigh the value of these cash flows that they're producing, here's a cash flow forecast for Elevance. I get a 61% discount, meaning the stock price is 61% lower than the value of the cash flows. When I look at their profits, the stock price is 50% below the value of their profits. So this is like a long-term value play. Over the long haul, this is probably going to work. Now, question that I like to ask is, how many of these big institutional investors, super investors, are bought in? 6 of them. 6 of them think Elevance is a good investment, including Glenn Greenberg, never heard of him. Leon Cooperman, I know who he is. But you have 6 investors that have big money accounts that are invested in Elevance, and they're adding. Okay, so that looks good. And while I'm here, I'm going to go into United Healthcare, which should impress people that all this smart money, 16 super investors own United Healthcare. So they know these are good businesses. Okay. It's not just me saying, oh, yeah, I think they're great. But no, these are like really, these guys are handling big, big investments. For example, Dodge and Cox owns $1.8 billion of United Healthcare. Okay. That's a huge investment. They're not just saying nice things about the stock. They're buying a huge position. So with that in mind, United Health is growing. They're generating more cash. The story around healthcare is ugly right now. A lot of stories are going against space. Got it. It's not going to be like that forever. We need healthcare insurance, period. We're not going to do without it. One of the things the U.S. has is a wonderful health industry. You go to a hospital, things are good, doctors are well trained, benefits are great. All those things are great. Okay, so this is one of the great institutions, great industries of the United States. And when I look at United Healthcare, I think United Healthcare is discounted by 54%. Same rationale. Look at their cash flows, weigh the value of these cash flows, created a forecast of these cash flows. And I get an intrinsic value and compare it against the current stock price. The current stock price is 56% below the value of the cash flows. Current stock price is 50% below the value of this stock based on its profits. So these are really good opportunities, but it's going to require some patience because the news couldn't get any worse. It could, but geez, we'd have to use our imaginations. It's been pretty horrible for especially United Healthcare. So those are my thoughts there. As we go into earnings, United Healthcare, I would say if United Healthcare comes out and says we're growing at 10%, this stock should rally. And I own United Healthcare. I own Elevance. I'd rather be a United Healthcare owner because it's just such a good brand. And you saw how many super investors own it. A lot of investors own it. So it's a very, very well respected company. So hopefully those comments are useful to you or interesting to you. If you're a member, a paid member, you get access to all these valuations. And 24/7, you can go in and look at my research, by the way. So thanks for asking, Sar Gill. Appreciate it. All right, we got one super chat on the board. Who's next? Who else wants me to look at a stock? If I don't see or hear anything, I'm gonna go ahead and conclude the live stream. It's been a good one. It's been nice to spend a part of my Saturday with you, but I think I'll move on if there's no interest. So year to date, we saw that already. Looks good. The biggest, most valuable companies. What's interesting is NVIDIA is doing great. PE is a little bit high. Microsoft PE is a little high. Apple, what's it doing with the PE of 33? That should be a 20. They're not growing. Amazon 37, that could be a little expensive. That's affordable. This should go up to 25 or 30. I think it's going to. Meta 28 seems about right. They're growing really nice. 109, really expensive. Berkshire is a different animal. I'm not going to cover that one. Tesla 191. and the company is stumbling. It's like it had terrible earnings, and investors are still paying 191 PE. Good luck with that. TSM, that seems pretty affordable. JP Morgan looks pretty good. Walmart's a little bit high. Eli Lilly high. So that's what we got for the big mega caps. Good stuff. So we covered ELB, United Healthcare. Any other super chat requests before I conclude the stream? All right, so I'll take that as a no. Everybody, thanks for tuning in. We had a lot of people attend. I appreciate it. Appreciate the interest. And this week we have big earnings, right? We got a lot of earnings, but the biggest ones, Microsoft, Meta, Amazon, and Apple. They're going to happen Wednesday, Thursday. So I think Monday's trading will probably be light, not uneventful. Tuesday, maybe about the same. Wednesday is maybe going to start drumming up some interest around the two earnings that are going to happen on that day. But then Thursday's trading should be really high volume. And the reason for it is we have two big earnings after the market closes on Wednesday. We have Microsoft and Meta after the market closes. And based on what these guys report, I think it's going to move the market on Thursday. And then on Thursday, after the market closes, Apple, Amazon, and that'll affect Friday's trading. So Thursday, Friday trading, that's when the fireworks are going to go off. First 3 days of trading, I don't think the volumes are going to be very high. And I think we're either going to grind up or grind down a little bit. I don't expect big moves. But Thursday, Friday is a different story. We could see a big sell-off toward the end of next week. Or we can see a nice little pickup toward the end of the week if these four companies announce really positive earnings. The market's going to go up. It's going to go up a little bit. If we have 3 out of 4 have bad earnings and they have bad guidance, big sell-off, like 2% down on the NASDAQ, like sell-off. That's what I imagine could happen next week. So that's what's going to happen. I'm going to try to do a watch party on Wednesday at 1 o'clock Pacific, 4 p.m. Eastern, so we can cover these kind of real time as they get released. And same thing for Thursday. I'll do a watch party, and we can watch these two stocks get released. It'd be fun to watch them. Cool. So looks like that is all we've got in the chat. Thanks, guys, for tuning in. Appreciate your time on a Saturday. Enjoy your Saturday, and I will talk with you soon. Take care.